All right, good morning, everyone, and welcome to this Canberra Business Chamber webinar on everyone's favourite subject, payroll tax. If you don't know me, I'm Greg Harford, the Chief Executive of the Chamber, and I'm joined today by Reece Cormick, a partner at Deloitte, who's going to talk us through everything you need to know and probably wish you didn't about payroll tax and how it works, how it operates. So we will have time for questions at the end, so please use the Q&A function at the bottom of your screen if you've got some questions, and we'll come to those at the end. But in the meantime, I'll hand over to Reece for his presentation, and I'll be back at the end. Thank you, Reece.
Thanks, Greg, and hi, everyone. We'll run for around 45 minutes to 50 minutes, running through some of the key aspects of payroll tax, particularly focusing on its application in the ACT. But would love to hear from you as well around the challenges that you might face in payroll tax or areas that you see should be raised through the chamber in respect of payroll tax. So we'll leave a bit of time at the end for questions. Feel free still to pipe in with any questions or thoughts in the meantime as we do go. So we'll run through today a brief background on payroll tax and its application within the ACT in the context of the ACT economy. Then we'll run through an overview of the key provisions and issues and how payroll tax works in practice. Then we'll go through the return process, how it works, the annual, the monthly, as well as some practical tips. And then we'll leave it at the end for a bit of a discussion. Can I just check that you can all see the screen there okay? Everything's coming through all right? I'll take that as
a Reece, so yes, carry on.
Excellent. Thanks, Greg. So for a brief history of payroll tax and where it sits in the context. So payroll tax with a dash in the middle was originally introduced by the Commonwealth in 1941 at the Commonwealth level rather than the states. It was introduced at a lower rate than it is today at 2.5%. It came in to fund what was a national welfare fund that was established predominantly to fund child endowment. Right on the back of World War II, essentially, as this was really kicking off. Following that, there was a history of deterioration of the fiscal power and revenue of the states, which came firstly from the transfer of income tax, that the states used to actually have income tax themselves. The Commonwealth in 1941 transferred the income tax from the states to themselves as the Commonwealth centrally. Then following that, the state's expenditure requirements continued to increase, whereas their revenue base still remained relatively stagnant. They tried to impose a few different taxes that was deemed unconstitutional by the High Court, and they sought to try to get more taxing power from the Commonwealth and see what they could do around getting more grants and more special purpose payments to help fund them. And there was a real tension between the Commonwealth and the states around that fiscal responsibility and the states having all of the expenditure requirements, whereas the Commonwealth having all of the taxing power. So in 1971, the Commonwealth then announced that it would transfer the payroll tax to the states, which has been the overall largest growth tax of the states since that day. The states collectively agreed to increase the rate of payroll tax to 3.5% immediately upon transfer. Following that, however, there was a very slow but steady divergence in the payroll tax rates, thresholds, and rules between the different states. It started from, first 1976, there was a doubling of the exemption and the threshold that was equal, but then very quickly there became differences as jurisdictions, particularly New South Wales and Victoria, wanted to incentivize particular business interests within their jurisdiction or show political signalling to small business. And as this divergence continued, different jurisdictions started to realize that it was very difficult to to comply with payroll tax in multiple jurisdictions as businesses then started to move into different jurisdictions and become more national. There were a number of reviews that occurred from different jurisdictions, led by the state premiers and treasurers to look into how payroll tax could be done better. In 2007, the state and territory treasurers then announced the decision to harmonise many aspects of payroll tax. And then harmonisation did occur across many of the provisions. So now we have harmonised payroll tax rules across many aspects, yet there are still some real substantial differences. There still is the requirement to lodge payroll tax returns in each jurisdiction. There's no one federal level tax or consolidated payroll tax return that is then distributed. There's different rates, there's different thresholds, and there's different exemptions, particularly for what's called the relevant contract provisions that we'll go into. And this does still make it very difficult for businesses to comply. And as some of you on the call as attendees may experience, operating businesses across jurisdictions is really difficult to comply. The Henry Tax Review a number of years ago saw this as a real issue in Australia's tax system, that the level of compliance burden and difficulty as businesses do become national and need to comply with different laws and different administrative regimes does really make the compliance burden quite complex. So payroll tax across the years. So the state and territory revenue, the graph on the top left there shows the steady climb of revenue across all jurisdictions. ACT, our total revenue comprises only 2% of total state and territory revenue. So ACT as a ACT government receives a real low proportion of revenue from taxes compared to other jurisdictions. If we look at the growth, however, over the decade, this is total revenue, not just payroll tax. If we look at the total decade, however, ACT has actually experienced the largest growth of its tax revenue base of any jurisdiction, doubling, 100% growth over the decade, which is quite interesting. If we look at that with payroll tax, payroll tax and land taxes certainly do in ACT represent the largest growth of their taxes over the decade. And that's driven by payroll tax wages increasing, more people coming into ACT and being paid higher amounts, and the land tax, more properties and higher values of land. You can see their payroll tax represents around 22% of total revenue growth over the decade there. Interestingly, as it's frequently cited for business as a difficult piece within ACT, is that ACT, while having the highest threshold, has the highest payroll tax rate, quite higher than the other jurisdictions. You can see there the graph on the right, the green bar is the standard, the highest rate of applying, and then the red there is essentially the surge rate or the penalty rate applying to big business. And ACT there, under what's just been announced for the coming in year of the 2025 income year. This was previously announced to start the year later, but in the budget just handed down on the 25th of June. This surcharge has been brought forward. So there's going to be an additional 2.5% payroll tax rate for taxable wages over 50 million. Businesses with Australia-wide wages over 50 million, and 0.5% for businesses with taxable wages Australia-wide over 100 million on the 2025 year. Those rates then double in the 2025-26 year to an additional 1%. So that will bring the rate there to almost 8%, 7.85% for the top rate in ACT, which is significantly higher than other jurisdictions. You can see from the rates there that some of the lowest rates, like Like Victoria on the base rate, they do have the additional 2% surcharge. However, you've got SA 4.9, South Australia, Queensland 4.9 as well, but with some surcharge rates. There's real differences in those rates and the thresholds, but ACT certainly does have the highest rate. It is interesting as a signalling around promoting small business essentially, but it does really discourage some larger businesses. It does make the cost of doing business in ACT for those large businesses more expensive. That payroll tax rate definitely does add up as a cost of doing business. To run through some of the key provisions. So payroll tax operates on the concept of taxable wages, looking at what kind of wages and payments are going to be subject to payroll tax. There's a number of payments that are specifically included as in, and there's certain payments that are specifically included as exempt from payroll tax. So your normal salary, wages, bonuses, allowances, commissions are in payroll tax net. ETP payments, superannuation guarantee amounts, fringe benefits tax items. Fringe benefits are taxable under the FBT regime, and then you consider what your FBT amounts are there, and then you'll apply a gross up to include the amount for taxable wages for payroll tax purposes, employee share scheme interests, directors' fees, payments to employment agencies, and wages paid to sick or injured employees as well are included as taxable wages, as an example. Certain payments are exempt from payroll tax, which include overnight travel allowances, motor vehicle allowances where they're below the commissioner's reasonable limits. New starters, so apprentices, trainees, receiving eligible training payments, and then your paid maternity, paid parental leave, and certain other leave is exempt from payroll tax. And another one is the tax-free part of a genuine redundancy payment, which can frequently be missed. That can frequently be included within payroll tax net accidentally. So these are the types of payments that are made, that are included. We'll speak in a second around the relevant contract provisions. But the nexus provisions are another important rule to apply. So those payroll tax thresholds that we had at the top is based on the Australia-wide wages. So in ACT, if your Australia-wide wages exceed the 2 million, you need to consider the proportion of your payroll tax where you exceed essentially your monthly proportion within ACT. And if you exceed that, then you've got an obligation to lodge payroll tax returns in the ACT. But because we've got different jurisdictions, the nexus provisions have been set up to determine which jurisdiction is going to have the right to tax. There's harmonized nexus provisions that have been brought in that essentially apply a series of steps. The next slide will show on a graph what most of those steps are. But the three key provisions is the first is that where services are performed wholly in one jurisdiction, so wholly in ACT in a month, taxable in ACT. Where performed in 2 or more jurisdictions, so example ACT and New South Wales, taxable in the jurisdiction where the employee's principal place of residence is. So if you've got someone who's based in ACT, their principal place of residence, but they're working in both ACT and Queanbeyan, New South Wales, you would look back to their principal place of residence. Back to that first one, if despite being principal place of residence in ACT, if they're performing all their services in Queanbeyan for a month, then they'll be taxable in New South Wales. Where neither of those can determine nexus, so the employee's principal place of residence might not be in Australia, or you might not be able to know where their principal place of residence is, then you'll look to the employer's principal place of residence, first taken as if they've got an ABN registered address in Australia. Typically, that first 1 or 2 steps determines where the nexus is. The third may then may then apply to look, and then there are other provisions that look at it afterwards. But we'd see that around 97% of situations, those top three tests would apply. That would then determine where the nexus is going to be. What this means in practice, though, is that where you've got workers across two or more jurisdictions, you do need to assess whether they're going to be taxed in that jurisdiction. This includes if they're working remotely. So if somebody lives in New South Wales or lives in Queensland, working remotely for an ACT business, the next provisions do require the services being performed in that remote location as the location where they are. So if they're wholly remote in that month, you would look to that location. This does create a bit of a burden and a requirement to look to where people are performing their work and where they are physically located, where their principal place of residence is. Where services are performed continuously outside Australia for more than 6 months, they'll not be taxable in an Australian jurisdiction. So that might be someone that's seconded overseas or working overseas for a period of 6 months or more. They can come back to Australia for holidays, etc., but to always return back to that location. There's a harmonised ruling, PTA 039, which applies this handy diagram, which you can see. I think you'll have it on the slides, or you look it up at the PTA 039, which applies the flow chart of the tests for stepping through to see which jurisdiction payroll tax is going to be in. They can see there the first one of, are services performed wholly in one jurisdiction? If yes, taxable in that jurisdiction. If no, if they're provided in two or more, then you look to where the principal place of residence is going to be. And if you can't determine that, then you look to the ABN address. Then you can look to where the wages may have been paid or payable as well. But there is a handy flow chart that can help you step through those provisions. So the relevant contract provisions are really interesting provisions that are currently causing a little bit of grief for taxpayers. And these are designed to tax payments to non-employee like workers. So those payments we mentioned above around your payments that are in for payroll tax and those that are out for payroll tax apply regardless, but more to a standard for employees. So common law employees are clearly considered employees for payroll tax purposes, and those kind of payments made to such common law employees are considered taxable wages for payroll tax purposes. Common law employees doesn't just mean those people that you engage as an employee. It still may mean contractors that still meet the definition of being a common law employee. So you've got control, they can't delegate, they're quite integrated into your business, etc. But beyond that, the payroll tax net is really broad in these relevant contract provisions. And there's different tests of who's an employee versus a contractor for all of the different employer obligations. So payroll tax, superannuation guarantee, pay-as-you-go withholding, fair work obligations, they've all got different definitions, which makes it really difficult to comply. But payroll tax is actually worded the most broadly, that it can pick up a broader type of worker than would be picked up for superannuation guarantee, for instance, or for fair work obligations. The provisions are worded incredibly broadly, that it's essentially where a payment is made for services under a relevant contract, they will be considered taxable wages unless an exemption applies. And there was a recent case where a loan company that had established a website where it would have mortgage brokers engage through the website to find customers. It was seen as engaging those workers under a relevant contract for their payments. And the commentary of the court said that it certainly did seem unfair, that these provisions were not initially intended to pick up these kind of situations, but the way that these relevant contract provisions are worded is such that you're in for the relevant contract provisions of making a payment under a contract for services, unless a very clear exemption applies. And there's many business structures now that weren't perceived when these provisions came in that are caught under the relevant contract provisions, and an exemption doesn't apply. So the ACT provisions for exemptions include where the supply of labour is secondary to supply of goods. So somebody who's clearly providing a good, they're selling a good to your business, and there might be some labour to help install it, for instance. That labour is secondary to the supply of that actual good and material. The second is that services are not ordinarily required by the business, and this requires that worker to be providing it outside to other members of the public as well, the same kind of service. And it might be the kind of service of you might have a one-off need for something that's not ordinarily required. There's owner-driver exemptions for delivery and transport of goods in a vehicle that's owned by the worker. It's important that that vehicle is owned by the worker. So your business can't essentially sell or lease or provide that vehicle, that truck or car to that worker. They've got to own it themselves. So this is the big trucking companies and delivery vehicles, etc., that this can provide an exemption for that transport of goods. Services ordinarily provided to the public is another exemption here, and this is in ACT. It's exempt where those services are provided for an average of 10 days or less per month, and the same type of services are provided elsewhere. So as an example here, general practitioners, which I'll speak about briefly in a minute. GPs has recently been quite under the spotlight of these relevant contract provisions. And GPs are usually provided services to a clinic and to their patients. And they might provide services to multiple clinics over a year. If they're providing services for less than 10 days a month, and they're providing the same type of GP services to other clinics, then they can be out from these provisions. If they're providing different types of services, however, so they might be lecturing in a university, they might be doing something else of that might still be medical related, but it's not GP services. It's not the same type of services. Work performed on a day also includes whether it's just performed for 1 hour or 8 hours. It doesn't matter. It's just being performed on that day. So you can very quickly get into the net when you're a part-time worker. These exemptions for the relevant contract provisions, unfortunately, do differ quite significantly across jurisdictions, and the ACT has quite limited exemptions compared to some of the other jurisdictions. This is a high-level snapshot of how these exemptions apply, and you can see that there's some real clear exemptions that don't apply in ACT that do apply in other locations. These include those door-to-door salesmen, insurance agents. It includes service performed by 2 or more people, so engaging others, and services provided for 90 days or less in a financial year. It can make it quite difficult for certain workers to get out of the payroll tax net in the ACT, whereas in other jurisdictions there's exemptions that are quite clear to get them out. Each of them do have, though, their own provisions and are quite prescriptive, and some of them do require the approval from the Commissioner of State or Territory Revenue. So I'll touch briefly on GPs and medical practices, and then where this might be going a little bit more broadly as well. So that those medical practices and the GPs we spoke about, and this has been in the news quite a bit in the last couple of years. There was some recent case law that came first out of New South Wales and Victoria around GPs and dentists and other kinds of medical practitioners, where the relevant contract provisions were used that the clinics were seen as the employer for payroll tax purposes in respect of the medical practitioner, GP, or dentist that they were engaging to provide services to patients. And historically, it's a really interesting one in that the GPs are certainly servicing patients, but the law has seen that the practice is engaging them to also provide the service to the patients, and they do essentially receive the revenue that they then distribute out to the patients as a percentage of what the payment is that has come under. So, which may include the Medicare or DVA payments as well. And it was seen as that these are still payments under a relevant contract, despite lots of arguments to try to get them out, including where a third-party arrangement payment might be set up of the practice might not actually receive the payment directly. It might be a square tapping system that the GP receives themselves and then makes a payment back to the clinic. The revenue authorities have all deemed these kind of payments as still being under the relevant contract provisions. As a result of certainly a GP shortage, certainly bulk billing percentages are at an all-time low. There's been a bit of media around this and push on revenue authorities around this and the impact of it impacting patients and the costs of medical services. So there's been various amnesties announced and different concessions in different jurisdictions. ACT's amnesty that has been announced is firstly to waive payroll tax on payments to GPs that are not common law employees, but that are caught under the relevant contract provisions up to 30 June 2023. Then for the period 2024 and up to 30 June 2025, there'll be an exemption for liabilities where the GP clinic bulk bills at least 65%, is registered for My Medicare, and as registered for the amnesty with ACT revenue. It is slightly narrow and it does only apply for GPs. So this doesn't apply for specialists. It doesn't apply for dentists and other medical practitioners. Interestingly, we're also seeing these kind of provisions being looked at by revenue authorities, including ACT revenue in respect of other industries at the moment that have similar kind of tripartite-like arrangements where a business is used to support finding clients for workers in one way or another. So online platforms that are set up that in the care industry is one where platforms are set up to engage carers to work work in nursing homes or work in homes that might need help for people that may need support. And this is really interesting in what it's going to mean, because ACT does have more limited exemptions of the relevant contract provisions to other jurisdictions. So this may mean that some of these type of businesses, it may not be commercially viable to be engaging workers in the ACT if the payroll tax cost is prohibitive upon these businesses, because many of these businesses do receive quite a low margin because the business is more providing an introductory service, and they provide quite a low margin on the fee that the worker has for their clients. So it's going to be interesting to see what does happen as a result of some of this activity at the moment. Another area of payroll tax of a key provision and concept is grouping. Because of the payroll tax threshold, so payroll tax only applies where your Australia-wide wages or your wages within that jurisdiction exceed the relevant threshold for the year. Businesses started to be set up to try to split themselves into multiple businesses that would each be below the threshold to then try to get outside of the relevant thresholds to then not have to pay payroll tax. Because of this, the grouping provisions were introduced, which have now been harmonised, that essentially treat multiple businesses as part of the same group to only apply a one threshold. It applies to related body corporates. It applies to businesses that use employees within more than one business. and it implies where there's a controlling interest across the multiple groups. Where there is a group for payroll tax purposes, only one member of that group is entitled to claim that threshold. And that employer is known as the designated group employer, or DGE, which is approved by the commissioner as the DGE. Where grouping applies, there's also joint and severable liability to apply payroll tax liabilities for other group members as well, which can be quite important to note. And grouping, there can be some common issues of where acquisitions might occur, so that you might have a business that has even foreign ownership. There might be a private equity firm or a foreign entity that's bought lots of Australian businesses, and each of those businesses, they may not even know about each other, but the foreign owned business or another ultimate ownership actually has control of all those businesses. All those businesses can be considered part of the same payroll tax group. Because of that, they might, unbeknownst to each other, each be applying the threshold. If state revenue sees through that and sees that there actually is a group for payroll tax purposes because of the common controlling interest, that may require a reassessment of payroll tax with penalties and interest applying potentially to reduce that threshold that's been applied by multiple entities. It can be quite a difficult one to identify where there are complex group structures. I'll speak around the return process now. So where taxable wages exceed the monthly threshold in the ACT, an employer is required to register for payroll tax and lodge payroll tax returns with registration by the 7th day after the end of that month in which it had exceeded. The designated group employer, where there's a payroll tax group, may lodge on behalf of some or all companies in that group as what's called a joint return lodger, or JRL, after they've submitted a JRL nomination to the state revenue or ACT revenue. There's different types of employers as well. So you might have an independent business that's not part of a group. They are entitled to the threshold on their own, and they are required to lodge where they exceed the thresholds. Designated group employer, yes, is part of a group. That's the entity that's part of a threshold and is required to lodge. An ordinary group member, so an entity part of a group, is not entitled to the threshold because the DGE has that threshold, is required to lodge unless that DGE has set up that JRL such that there's only going to be the one lodgement undertaken by the designated group employer. Often we see that where you've got corporate structures, sometimes businesses oversee this JRL nomination, which results in often having to do multiple lodgements, which ultimately do end up as the same payroll tax liability. So this JRL nomination can be quite beneficial to reduce that administrative burden to only require one lodgement or one return per group within the jurisdiction. The return process has been set up pretty recently to be quite streamlined now under a self-service portal where you log in via your digital identity on your phone, the same as you log in via the ATO and other government platforms. The smart forms that were previously used are starting to be phased out, which is good news because this self-service portal is quite easy to use. You can set this up as your own as a business to lodge on your own, or you can establish to provide a tax agent with the authority to have access to your instance to then be able to lodge as well. Employers who exceed that monthly that tax-free threshold, so the threshold for the year, need to lodge monthly returns for every month, excluding June, in which an annual reconciliation return occurs. So what this means is for each month that you've got the obligation, you lodge your returns, and those returns declare the taxable wages to revenue. Then the annual return goes back and says, all right, what were the actual amounts that had to be paid? If there were adjustments that may have occurred during the year, there might have been things that were missed, or you might pick up non-payroll items like directors' payments that might be paid through accounts payable, relevant contractor payments, employee share scheme interests, things that might not be as easy to find over the year. They may be included in the annual return. You provide the reconciliation. You see if there's any additional amount payable or refundable over the year. So the due dates for those returns, the standard returns, the monthly returns from July to November, and January to May are due the 7th day of the following month. The December return for a bit of a Christmas break is due another 7 days later on the 14th of January. And the annual return reconciliation, 28th of July, where this date does fall on a weekend or public holiday, it is the following day. And these dates are pretty consistent across jurisdictions, with the exception of the annual return, with some annual returns in other jurisdictions due the 21st. For some practical tips and things we've seen. So the first broadly is around systems, process, and governance around payroll tax process. So we see a lot of businesses' payroll tax return workbooks, and we see almost everybody using an Excel spreadsheet that's very similar to each other, where they'll pull out their payroll data from their payroll system, put it into a spreadsheet, analyze it across the jurisdictions, and pull in different data. They'll reconcile that, and that's their monthly return. They then have their annual, which then looks at each month, provides a reconciliation at the end, and they log into the state revenue portal, make the payment, provide a reference number as well. Frequently in businesses, the people that are responsible for payroll tax is either someone in the finance team or the payroll team, or someone responsible for a little bit of both. Sometimes that person can frequently change. And payroll tax, with its different rules across different jurisdictions, should always be documented in one way or another. So try to make your administrative process that you do each month and each year as streamlined as possible and as documented as possible, so that it takes as little time as you need each month and at the annual, and that if the person leaves that is doing the payroll tax return, it can be picked up by somebody else. Because a lot of the concepts of payroll tax are relatively simple once you've got the systems in place. It's your amounts from your payroll tax, from your pay system. It's your non-pay systems. It's picking up your grouping. It's picking up your relevant contractors. Once you've got all those together, if you've got the systems in place that can pick it up, you should be able to have it on a pretty regular, recurring basis to reduce your administrative burden. And then you can have a checklist of your own, of make sure that you're going through and checking the kind of risk areas that you know are going to be relevant for your business to make sure they can be picked up. Some areas that we see that payroll tax may be underpaid, or that the right payroll tax base is not really covered. One is those businesses not always knowing who's in their payroll tax group. The example is that foreign-owned group or complex business structures. Second can be not always considering or being aware of those non-payroll tax data sources. So it might be certain allowances paid through an expense payment system. It could be fringe benefits. It could be employee share schemes and other payments. Payments under a relevant contract are certainly relevant. So independent contractors is frequent, but then it's those businesses that their whole being is essentially making payments under relevant contractors that may not be exceeding the threshold or paying payroll tax at all, other than the relevant contractor provisions. Payments made to directors are in as well, and those nexus provisions. So making sure that those lodgement obligations are met where employees are working in different jurisdictions. So ACT businesses that now have somebody who's working fully remote in another jurisdiction, consider whether you've got a return obligation in another jurisdiction. There's also, on the flip side, is making sure that all the available exemptions are met as well. So the types of payments that are exempt from payroll tax, so the tax-free part of an ETP or general redundancy payment, those allowances below the thresholds, car parking fringe benefits in Queensland is another one that's frequently missed. So making sure that you're not just seeing all payments and putting them all in, you're actually looking to see what type of payments can be exempt. Consider the application of designated group employer as well, and application of thresholds, and being wise around the structure around who the DGE is in location, so that you can maximize the application of the thresholds across the different jurisdictions you may be operating in. Considering apprentices and other exempt wages is another one, to make sure that exempt employees are picked up, and where there may be a charitable exemption. It's not necessarily linked to the ACNC definition of a charity, and you can apply to the Commissioner of Revenue to look into the treatment of a business as being considered charity for payroll tax purposes, to then be exempt as well. So broadly, yeah. So payroll tax, ACT, we're in an interesting position that ACT does have such a high payroll tax threshold, which means that around 90% of businesses in ACT are exempt from payroll tax. We've also got Commonwealth as a very large employer in ACT, but constitutionally, ACT as a territory or state can't actually tax the Commonwealth. So all those Commonwealth employees in the Commonwealth are outside of the payroll tax net from their employers, which means that our ACT payroll tax net is actually smaller than it would have been otherwise. The signalling by ACT government around having such a high payroll tax rate, as well as the recent surge rate across larger businesses, is a bit of a signalling, unfortunately, against larger businesses, because it does result in a higher cost. And it's going to be interesting to see if businesses will decide to not do as much activity located in ACT because of those. We went through some of the key provisions. So what's in for taxable wages, what's out for taxable wages. We went through the grouping provisions. So you can't get out of payroll tax by splitting your business into multiple businesses that still has common ownership or control. They will still be seen as the same payroll tax group, and you can't get out of payroll tax by being under the threshold. Went through those relevant contract provisions that is quite topical at the moment in a number of areas. Number of industries are really seeing this as a difficult area, and we're seeing revenue, including ACT revenue, focusing on this one quite a lot. And then we spoke about some of the ways you do your payroll tax returns on a monthly basis and the annual reconciliation, and to try to make sure that you can streamline those processes as much as you can through getting your SOPs in place, and through getting your process to pick up those non-payroll data as well. We had a couple of tips around making payroll tax easy, and making sure that you are picking up those types of taxable wages and payments that might not always be considered, but then also excluding those that are relevant. We do see payroll tax frequently cited in the news and by bodies, including the Australian Chamber of Commerce, around this is a high cost of business. It's really hard, both from an administrative perspective, for businesses to comply with payroll tax, because they've got to do it in multiple jurisdictions, and that cost is really high. When you're looking at 6, 7, 8% of total payments made to workers, employees, and relevant contractors, that cost really adds up and becomes a high cost of doing business. Whether reform will happen is yet to be seen. While it is frequently put forward as reform should be needed to reduce this payroll tax cost, particularly the administrative cost on big business or business generally, it's going to be really difficult, because this is such a critical revenue source for state and territory governments. And looking at the history of payroll tax and why it was here in the first place is this was given to states by the Commonwealth to give them that growth revenue. So I can't see anytime soon this kind of the Commonwealth taking any more control over this or any more harmonization. I think it's going to continue to be a difficult tax for business, because state and territories are going to be it's going to be really hard fiscally for them to give it up. So what that means is businesses do need to, in the absence of that, try to set your processes up the right way. Try to be smart around finding the exemptions that can apply and setting up your systems to make this administratively more clean to comply with. Greg, over to you. I know that the Chamber's been seeing payroll tax as an issue, and it's certainly a hot topic in ACT at the moment with these recently announced surge rates.
Yeah, thanks, Reece. Now, look, this is the time when we're going to take any questions that anyone might have. So if you've got any questions, drop them into the Q&A function. I guess just to kind of give you a bit of a view on where the Chamber sits on payroll tax, it is one of the things which we think acts as a real disincentive for business to grow here in the ACT. So we're certainly pushing for a review of kind of where payroll tax sits. And a greater alignment federally on kind of where those rates are. Given though that there is little prospect of any kind of harmonisation in the short term, there is a real opportunity, I think, for territories like the ACT to be able to carve themselves out as perhaps a low payroll tax jurisdiction, and therefore attract more business. But that's not the direction that we're currently seeing from government. And in fact, the surcharge that was announced on 3 days' notice in the budget this year that came into effect on the 1st of July is a further disincentive to business, as you say, Reece. Chamber is working really hard in the background to try and get government to reconsider that decision, but we'll see where that goes. Look, there's a couple of questions, Reece, if you've got a few minutes. Just to clarify, so the $2 million threshold applies to your entire Australia-wide business, not just your business here in the ACT. So if you do, say, $2.5 million worth of wages and $2 million is outside the ACT, $500,000 is here, you're still hit by the ACT payroll tax regime. Yes?
Yeah, broadly that's right. Yeah. Although you will still look at your portion of your 2 mil for the ACT, your taxable wages here as well. But yeah, that 2 million is based on your Australia-wide wages.
Okay. Now, with the surcharge that's kicked in for big businesses over that $50 or $100 million threshold, one of the concerns that's been raised is around what happens if you're close to that threshold and you might tip over it, because if you're passing that surcharge on to your customers, and there's some challenges in making that happen on very short notice, but if you're agreeing with your customers that you're passing that surcharge on, and you tip over from one threshold into the next, you potentially end up with a greater bill than you might have had at the end of the year, or indeed needing to go back to your customers. Have you any thoughts on how businesses might manage that?
That's a really interesting question. And I guess it is going to be a commercial question and a contracting question that while you might have a question under the Payroll Tax Act for whether you've exceeded the threshold based on your wages, you may be able to word a contract to have decision points around where it's going to be, or to still recover it after the fact if you do go over. Or maybe charge it at the front if you think you're going to, and then you refund the customer if you end up not receiving it over the end of the year. But yeah, that's practically going to be a difficult one for you. You're either going to have to assume you're in at the front, assume you're out, and then reassess at the end, or have a decision point in the middle where you're going to be able to do it.
Yeah, okay. And what mistakes are we seeing businesses commonly make around payroll tax? And I guess really, what are the biggest risks that we are seeing, and what are the biggest potential cost savings that can be realised that people might not be aware of?
Yeah, good question, Greg. I'd probably see that for For large businesses, the grouping provisions are certainly one where they've got complex structures. For smaller business, probably the ones where they're missing the most would be around the relevant contract provisions, but also around share schemes and fringe benefits. They'd be some of the key ones around not picking those up the right way. The areas where there's probably areas to improve and to save, maybe apprentices and trainees, and maybe picking up the types of payments that are exempt as well. So those tax-free components and others as well. But yeah, there's definitely a mix of the payroll tax net is wider than businesses typically see, that it's not just your amount paid in your payroll to employees. You also got to pick up these other payments, directors, relevant contractors, share schemes, fringe benefits, all these types of remuneration. So making sure that all of those are included in the net and in your broader group. But then try to see what else you can get out, which is those items there as well. ACT revenue is probably we see focusing around some of the provisions around the relevant contract provisions at the moment is one that we do see a little bit of their focus on.
Yeah. Okay. Thank you. Well, look, those seem to be all the questions we've got. So, Rhys Cormack from Deloitte, thank you very much for joining us this morning with that really interesting webinar on payroll tax. We will have this webinar recorded and available for if you want to come back and have a look at it. But otherwise, if you've got any questions or you want to connect with Rhys, please just connect with us via the chamber and we can make that happen. Rhys, thank you very much. Really appreciate your time.
Thanks, Greg. Thanks, everyone.